Drop it.
Welcome back, my passive income investors. I like it. We have an incredibly large amount to go over this week, so we're going to do this systematically, as always, starting with the portfolio overview, getting right into the dividend income on the far left here, ladies and gentlemen. I have noted something unbelievably wild. My annual yield right now is $6,184, up from last Friday's update, but from the beginning of the year, I realized, because I wrote it down, my annual yield was $5,342. That is an increase over the last 5 months of $700 annually. That's more than $130 a month. And this is something I keep reaming to you guys, that this is one of the greatest investment opportunities of your lifetime, because my income is abysmal. As many of you know, I've lost my job. I'm actually making less money now than I have in the last 5 years of my career. But just reinvesting dividends and throwing $500 to $1,000 a month at the portfolio, we can see that those dividends are exploding faster than they ever have, which is the beautiful reality of compound interest. And to show you the robustness of my 14 positions, no ETFs, no 20, 30 positions in an M1 finance account, just taking a look, I'm sitting at $139,085 for the week end, which again, going back to the beginning of the year, and you guys can check these videos out because I publicize all of this, I was sitting on $30,898. So I'm actually up roughly $9,000 on the year. Now, if I were to minus out my contributions to the account, you could probably wipe away about $5,000. So I'm not up massively on the year, but considering we are in the midst of a crash, to be green at all is to be grateful. Now, taking a look at the total value for where all my money is allocated, guys, we can see that the information and technology is slowly itching higher as Facebook starts to outperform, hitting all-time highs. Obviously, same with Microsoft and Apple, and even Tesla being those largest positions. It has raised it to about 38% of the portfolio, which I'm very happy with. I'm not adding to those positions. I'm not subtracting. And where most of my attention has been, as you guys are aware, is in the real estate investment trust realm, as I've even been throwing my line of credit at some of these REITs, which I will touch base on. But do keep in mind, the portfolio overview never includes any debt that has been added to the portfolio. These are just the exact values. And taking a look at that real estate sector, it only makes up 9% of my contributions, but in the dividend income, it makes up 27%. Whereas in this moment, I really want to increase that from 9% to somewhere between 10 and 15. I would love to do the same with my healthcare sector, primarily just being Johnson & Johnson. And other than that, everything else remains pretty much unchanged. I've slightly increased the cash position over last week. We're sitting on about $2,250. I don't plan on touching that. I'm going to continue to grow my emergency fund / cash position. And before we head into those individual accounts, if you guys find value in my transparency, as always, slap that like button. And if you would like to track your portfolio the same way I do here and support this channel while my full-time career income has been absolutely abysmal, head on over to the chartmaster.com, guys, what I would consider some of the best portfolio trackers currently available on the market. But getting right into this, guys, as always, starting with my tax-free savings account, we're going to start at the very top and rip our way through this. The whole account has been pretty much unchanged over last month. I think we are slightly in the green, though. But taking a look at the Canadian banks have been a very hot topic because we have earnings coming out. And in my opinion, the Canadian banks are way more robust than the U.S. banks. A lot of people looked at the U.S. bank earnings and thought they were abysmal. But you have to remember, they were building up loan loss provisions to protect themselves from any dents and dings that are going to be around the corner in the next few months. Whereas the Canadian banks were actually building up loan loss provisions well before leading into this crash. And that was because they were worried about a credit crunch here in Canada. So I think because they were already well capitalized, they should have better earnings than what we saw out of the US. Now, I have been averaging into these over this month because, again, I've been using dividends to buy them back. I'm still going to try and itch in little positions every now and again when I just have that extra capital, not sure where to throw it. Now, taking a look at my utilities, we got Northland Power and we got Southern Company. Once I get through getting my eyeballs off the real estate and kind of the healthcare part of my portfolio, I really want to start scaling my utilities because they have proven themselves in this crash to be complete stabilizers. In fact, I am up pretty substantially on Northland Power, and I wouldn't mind scaling Southern Company up to roughly the same size, which meaning I need to add about another $7 to 10,000 to that aspect of the portfolio. I'll touch base more on my REOCAN and my REITs when we get into the managed account because that's where I'm leveraging debt. But let's get into the US half of the portfolio. We can see MO and BTI, guys. My BTI paid me out a massive dividend, actually an increased dividend. I really love my SIN stocks here. Other than MO has been getting slaughtered through this, I'm glad that BTI has been more of a stabilizer. I don't plan on adding or selling those positions. They are at full scale still, and I'm just glad I'm getting that income. With Apple and Microsoft obviously leading the way in this portfolio, guys, these things are just towering over all my other positions. I think because Apple's back over 300 here, sitting at 317 today. I think Apple's actually the largest position as of this moment in the entire portfolio. If you notice one little weird thing over last week, yeah, I bought a little bit of MindMed today in this portfolio. Taking a look, not a whole lot, only $170 worth. I want to buy one more tranche of MindMed in my other account, and then I'll have finalized that. If you guys don't know anything about MindMed, it's a psychedelic company. I made a whole video on it. I suggest you go check that out. But other than that, if you guys actually want to help me out with some homework here, I've been asking a lot of people about GEO Group over the last week because when I look at the balance sheet, it is just beautiful, guys. I mean, they can afford the dividend, which is something like 16%. They still got decent income coming in, yet it just remains flat between this $10 and $11 range. And when I look at that balance sheet, it screams a buy to me, but I don't know why it's holding down so low considering the performance has been pretty stellar in this crash. So if you guys can figure out if it's just political, is there a lot of hate, a lot of bad media around the company, I can't figure it out. I feel like there might be some insider trading going on and something abysmal could be around the corner. So therefore, I'm not adding any more to the position, but I got no problem taking those fat, juicy dividends, baby. Now let's get into the RR to the S to the P, ladies and gents, where I can't really utilize any of this capital because it's retirement money. I'm not supposed to touch till I'm, 50 or 60, but nonetheless, this account has had the best performance out of everything. Facebook's been exploding. I have more Facebook, as many of you remember. I kind of pulled some money out of here from an over contribution, but we'll take a look at my other Facebook position, which is on fire. But taking a look, J&J and Tesla moving the portfolio here. Glad I don't have a lot of Wells Fargo in here. Now, financials and real estate seem like incredible yields, but they could be yield traps. I mean, we don't know how bad this pandemic gets. So if you want safe, risk-free dividends, and you don't want to watch the volatility in your portfolio, that is by far the sector that is stabilizing my portfolio nonetheless. But let's take a look at the managed account. Actually, before I touch base on this managed account, because I'm going to touch base on this debt. A lot of people have been reaming me out over the debt that I've been utilizing. Let's just take a look at the Royal Bank account, which is actually up a little bit on the week because last time I checked it, I was below 5,000. So nice to see we're having a little bit of a comeback here. We got REOCAN in here, and you guys can take a look. They're all the same positions I have amongst my other stocks. It's just I bought them at a really bad time, apparently, and I'm still happy with them. I'm not changing anything. I'm going to try and add my final MindMed position in this account so I have it spread out amongst all of my portfolios. So if things really do work out, all the portfolios will have a nice bump. But let's start talking about this debt here, ladies and gentlemen, and the positions in my managed account. So obviously, Facebook is leading the way in this managed account, and you guys know I bought MindMed last week in this account. Every time I bring up debt and using it to buy into real estate investment trust, there's always somebody lined up to read me out 10 ways to hell about why this is such a bad idea. Now, I want to explain to you one more time why I'm utilizing debt, why I'm going to scale this position to about $6,000 in debt, because it just seems brilliant to me and I wouldn't have done it in any other circumstance. Now, keep in mind, ladies and gents, I don't overstretch myself. First of all, you're looking at a $140,000 portfolio. Right now, $2,000 in debt is barely a drop in the pond. In fact, if this company went bankrupt, I mean, I would notice it because it's a rather large position, including the capital I personally added. But in the debt aspect of it, guys, it's so nominal, it doesn't even matter. And in fact, I have the exact amount of cash sitting in my emergency fund to literally cover 100% of that debt. Now, you guys can see the credit line here. It's at 4.9%. It is a floating interest rate, not a margin account. I can't get a margin call, but there's nothing saying that in a month the interest rate couldn't go back up to 6 or 7%. But at 4.9%, if we go into the actual dividend income, I'm making, again, I threw in a couple hundred more to this, so do keep in mind I did add a little bit of my own money here. But overall, the position itself is what, $1,997. Going into the dividend income, I'm making $228. So I'm paying roughly $8 a month off this $2,000 in debt and credit. That is the minimum payment required. But when I did the math on this, which you guys can go check out in another video that I made, I think I'm bringing in $16, $20 a month. Now, in the near term, what I plan on doing is only doing interest-only payments. because my end goal right now is to accumulate as many shares as possible at the current conditions RioCan sits at, but I want to do it in a really safe manner, because I mean, I could have easily threw, that $6,000 at this all at once, but I'm going to stagger it month over month. So I just want to see how RioCan does for the month of May. Going into June, presuming the dividends come in and everything's clean and the debt works out, I will be throwing another $2,000 at it. And then come into July, presuming everything continues to truck along the same way, I will throw my final tranche of $2,000 in debt, hopefully being under $15 a share, in which I am just going to ride it out. Again, guys, if I'm getting a 10% yield, or heck, even a 9.9%, 4.9 goes to the bank, 5% goes in my pocket, which is absolutely wonderful. I'm not here to justify to the idiots out there that haven't done their homework on the company why I like this company and why I feel it's worth throwing debt at it. So I'm not going to sit here and listen to you tell me why RioCan is such a terrible investment. If it doesn't work out for me, you guys will get to watch it. So consider subscribing if you think I'm an idiot. But just really quickly, one more time, I want to touch base on the portfolio performance. So what you see here, guys, just to summarize this and kind of clarify this information, all the solid lines. So the orange solid line is my managed account, the black line is my RRSP, and the blue line is my TFSA. Now, if we take a look compared to the S&P 500, the S&P TSX, along with the Dow Jones and the NASDAQ 100, we can see that the performance overall has been well above the basic averages, except for the NASDAQ 100. The reason I'm showing you this, I have updated it and showed you guys more recently, but I just want to show you the robustness of a portfolio that only consists of 14 stocks. And I know now that Robinhood is offering fractional share buying, a lot of M1 finance community people have been asking me about this. It comes up as a fairly regular topic about why you don't need to be owning 40, 50, or 100 positions. I mean, take a look. I got 140,000 between 14 stocks, outperforming the basic indices consistently over time. And I just want to show you this as the example of simplicity. A lot of people I've been listening to in the community have been changing their stocks out like they changed their underwear. It's actually pretty hilarious. Or they're owning 50 or 100 stocks. I sleep much easier at night, really understanding my 14 positions. And when I look at the performance, I sleep even better at night. So I'm just, again, showing you the comparisons. I would love to see the performance. If you have a portfolio of, say, 50 or 100 stocks, can you please share it with me? You can head over to thechartmaster.com, get the email, and maybe send me a message here, because I'd love to see what your performance looks like on a 50 or 100 stock portfolio, because I've noticed a lot of people that have 40 or 50 positions, like PPCE, for example, have been experiencing dividend cuts. But because I've been very careful at selecting my dividend stocks, as of recent, I have experienced 0 dividend cuts. But keep in mind, I own a very tiny percentage of Wells Fargo, under $1,000 position. It's the smallest, actually, it's one of the smallest positions next to MindMed in my portfolio, and even they haven't cut the dividend yet. But that's where I'm likely to see a dividend cut. If I were to pick one of my stocks, that's probably going to have a big problem in the near term. I want to update you too on my practice account. As many of you remember, Francisco, Portuguese monkey with Russian accent, that I use to make my random account picks. I know most of you that aren't OG to the channel aren't going to know what the hell I'm talking about, but nonetheless, this is a practice account I slapped together, because I kept saying how if you bought the S&P top 10 stocks, and I bought these just before the crash, that you would always outperform the basic markets. And I just want to update you on that today, as this account currently sits down only 6% on the year. Comparing that to the S&P 500, which is actually down 9.42%. So I'm still consistently proving to myself that if you just went on the Vanguard S&P 500, like the VOO or the SPY, and you just bought those top companies, guys, which I have done in this account, you will always pretty much be outperforming the basic indices. Now, obviously, it's not in the green, but it's still performing better to the downside. Just another example. I don't know what to make of it. I just like showing you guys these statistics because I find them very fascinating, and hopefully they help you structure your portfolio better. But again, I would love to know what you guys think, as always, in that comment section below. We're going to be doing a lot of live streams tonight, so if you're watching this early on, you can catch us on the Independent Investor channel from 9 till 10, and then from 10 till 11, you can join us on our new channel, Passive Income Educator, where we will bring the party in the live stream over there. But stay cool, stay awesome, and I'll catch you tomorrow.